Every nation is buried under debt, a fact we accept as normal. But a simple question pierces the facade. If everyone is in debtor, who is the ultimate creditor? The answer is not a person or a family. True creditor is not a who, but a what. Self-perpetuating financial system designed to survive at all costs. This is the story of the hidden architecture that profits from permanent global debt. Money's history is a story of abstraction, moving from tangible objects to pure belief. It began with goldsmiths issuing paper receipts for more gold than they held, creating money from debt. The final break came in 1971, when money was untethered from gold entirely, becoming a promise backed only by more promises. This created a closed loop where value is derived solely from trust, in a system that must constantly create new debt to validate the old. The modern machinery began in 1694 to fund a war. Private financiers loaned gold to the English crown, receiving interest and tradable bonds in return. This ingenious move transformed national debt from a royal burden into a financial product. The state's survival became permanently linked to the financiers who held its debt, establishing the foundational relationship that defines our world. This model scaled over centuries, fueled by wars and the modern welfare state. Governments, needing vast funds, issued bonds. Banks and institutions bought them, then used these risk-free assets as collateral to create even more loans in the economy. A powerful symbiosis was born. Sovereign debt issuance became the raw material for private money creation. Each fed the other in an expanding cycle. The true turning point arrived in 1971, when the gold anchor was cut. With no physical limit, debt could now expand infinitely, constrained only by the specter of inflation. The system's reliance on its central nervous system, the central banks, became absolute. Their role as lender of last resort evolved into the keeper of the entire game. The 2008 crisis was the ultimate test, revealing the machine's fatal flaw. It was choking on its own bad debt. The solution, however, was not reform, but a dramatic escalation. Central banks performed the ultimate magic trick, quantitative easing. They created trillions in digital currency out of nothing and used it to buy the mountains of sovereign and corporate debt. In that moment, the hidden creditor was fully revealed. The primary holder of a nation's debt became its own central bank, a stunning closed loop, where one arm of the state monetizes the promises of another. The system was saved by doubling down on its original sin. Today, the pattern accelerates with mathematical precision. Global debt has soared past $307 trillion. Central bank balance sheets, bloated with the bonds they've purchased, have exploded from $5 to over $30 trillion since 2008. They are now the largest creditors. To their own governments, the cycle is now predictable. A crisis hits. Governments borrow and spend massively. Debt markets strain, and central banks intervene with newly created money to buy that debt, keeping the system liquid. This new money floods financial markets, inflating asset prices like stocks and real estate, enriching those who already own them. Eventually, it leaks into the real economy as consumer price inflation. The public pays the cost twice, first through the future taxes that service the debt, and second through the silent, stealthy tax of inflation that erodes their wages and savings. The true beneficiaries are those closest to the source of the new money, large financial institutions and asset holders. The system itself is the hidden creditor, a financial Ouroboros, forever consuming its own tail to survive. There are three critical truths to take from this. First, the national debt is largely an internal accounting fiction. A significant portion is an IOU from the government to its own central bank. The real burden is the inflation and economic distortion required to manage it. Second, the system's prime directive is perpetuation, not broad prosperity. Its goal is to prevent collapse, making growth a welcome byproduct, but not the core objective. Third, you are not the customer. You are the collateral. Your future economic output, taxed, is the promised repayment. Your labor and assets underpin the entire structure. The warning is clear. This design inherently manufactures inequality and instability. Every fix injects more debt, making the organism larger and more fragile, not healthier. The ultimate risk is not a numerical default, but a catastrophic loss of trust in the currency itself, the final fatal break in the promise. Understanding this is not an exercise in doom, but in clarity. It is about seeing the true rules of the game you are forced to play. When you see the architecture, you can navigate its currents. Educate yourself on monetary history. Study what has preserved value when faith in paper currencies has failed throughout time. Diversify not just your assets, but your understanding. To see the 5 key historical moments that locked this system into place, watch our next essential video. This is not conspiracy. It is cause and effect. Recognize the cause to better understand the effects shaping your world.